Hey, welcome to the Capital Discussions Market Analysis. I'm Tom Nunnermaker with Jim Riggio, and we made it to March, so winter is almost over. But before we get started, a short disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is at the bottom of all of our web pages if you care to read it in its entirety. So with that, Jim, do you want the ball first?
Sure, I'll take the ball.
Okay, and we're still waiting for Curtis to call in.
Come over here and let me share my desktop.
Hey, welcome, Curtis.
Hi.
Okay. Curtis, how's it going?
All right. You should leave that picture of Arlene up for a little longer.
Did you see that?
Yeah.
Yeah.
I haven't seen her in a couple of years.
We've done good, huh? Okay.
You have. Yeah. Proud of you guys.
So, I'm not ever allowed to end up saying this, but, I realize that if you've ever had to hire salespeople in your life, and let's say salesmen, okay, because women have feelings, they're much deeper than men. Men are much more primal. I realize that if you're hiring a sales guy in his 20s or 30s, you don't need to see his resume. You don't need to end up interviewing. You just have to end up looking at his wife or his girlfriend, make sure that she's a shitload better looking than him. Because if he can't sell himself, how's he ever going to sell the shit you're going to ask him to sell? Anyway, oh my God, Curtis, this market, if you take a look at this morning, right, I don't know if, here, let me just take a look at one at a time. This market has just been absolutely unbelievable. Okay, when you end up taking a look at this morning's action, every time the market tries to sell off, okay, as soon as the market opens and money floods into the market and we move up, and then in the last few hours, okay, we moved up again. To me, this has been incredibly, okay, I don't want to call it bullish. You almost have to end up standing out of the way, out of everything. If I take a look at the oscillators on the SPX, let me get rid of this over here on the side. When I take a look at this, everything is still pointing higher. One of the things that has been very, very scary is that as we've moved up here, all of the moving averages and the oscillators, whenever we've had any sell-off, it's been met with just incredibly strong buying. In the fourth quarter, we had two very, very large moves in terms of the VIX moving up. But there was this disconnect between that the markets didn't sell off nearly as much as the VIX went up. A matter of fact, I saw one Goldman Sachs report during that time where it showed that the VIX had jumped 4 points more than what their quantitative models would have suggested based on the level that the SPX came down. When I take a look at this and you start looking at things like Fibonacci extensions or Hindenburg factors or drawers of death type, right? All of these different things I'm reading so many newsletters that are saying that, we are at unhealthy levels. The challenge that I end up seeing is twofold. One, just like in 2006 and 7, we were going up and going up, you need to have an event, right? There needs to be an event. Okay, we're not just going to sell off for no reason, okay? With the level of quantitative easing that has gone on in Europe, the bailouts that are in place for Greece, the quantitative easing that's in Japan. There's too much money flooding into the market for there to be a sell-off without some type of a catalyst. What that is, it could end up being anything at some point. But what really, really scares me is that because the level of VIX, and we've had, I'll call them minor sell-offs, okay, over the last, 3, 4, 5 months, these little tiny sell-offs, the VIX has jumped very, very quickly, which means that unless there's any type of, rescue, okay, the plunge protection team, or more quantitative easing, or the Federal Reserve and the other central banks stepping in, when the sell-off comes, I think it's going to end up being rather ugly. You're watching the markets all the time, Kurt. What are you seeing?
Well, I think the capital just doesn't have any place else to go right now. I think all the volatility in the fourth quarter had to do with a 6-month projection on a Fed move in June. So we had all that noise for 3 months, and it just really didn't amount to much of anything. It just kept going up because capital finally, each time would go, well, we don't know what else to buy, so we'll buy the SPY. I mean, that's very simplistic, but honestly, I think that's what's going on. There's no place else.
It's simplistic, but it's also, have you ever seen the models? Like, I've seen models where they'll take a look at, let's say, triple B bonds, okay, the lowest end of non-junk, and they'll take a look at what that return is, and when you're evaluating companies, whether or not to end up buying them, you basically look at 2 things, right? One of the more, let's call it value-based or fundamental models will be, the return will be the average of the triple B bonds versus the yield, the earnings yield, and the dividend yield. And by that I mean, dividend yield everybody knows, but the earning yield is basically the P ratio upside down. Right? It's how much, what's the corporate, what's the market cap of the company, and that's in the denominator, and then you take a look at their earnings, and you put that in the numerator. And so when you take a look at those 2 things together, are they earning more than the triple B? And the answer is obviously, the dividend is by itself. So where's somebody going to end up putting the money? And the answer is it just kept flooding into the equity market. And unless we have some type of movement in interest rates, that simplistic view of there's no place better to go, I think it's true. You take a look at commodities, people who try to end up doing commodities, okay, if you touched oil on the long side, okay, you got your head handed to you. We were talking a little bit about gold before we started the recording. I don't understand with gold, okay, where, why isn't gold moving more often? Gold is such a hard thing to end up playing. This is sink or swim, okay? I don't know if there we go. Every time it tries to end up making a move higher, okay, it just seems to end up getting slapped right back down. It's almost the inverse of the market these days. So, anyway, that's where I am. Tom, I don't have the questions, and I know there was a lot of chat stuff going on. Do you want to end up just kind of following that and seeing if there's anything in there for ELT? Tom, did we lose you? Okay, everybody has an opinion or goes.
Yeah, I'm here. There was just some discussion about the option view calculating gains and losses incorrectly. So there's nothing really about the market itself.
So, Tom, did you know what was going on with that, or with the option view calculating the gains or losses incorrectly?
This is the first time I've heard it, so I'm suggesting that they just send it to Len at Option View. He'd be the best one to fix it. He's the programmer, so Len at optionview.com.
Yeah.
Also, what the problem that I had with Option View the last 10 days or so is that some of my modeling settings were changing randomly when I didn't change them, so I had to go back through and recheck everything. And once I got it fixed up, it was okay. It was more of a problem that the platform was doing some funny things to my settings.
And like your settings were getting changed?
Yeah, the volatility model got changed in one underlying in the SPX. So instead of, I was looking at 200 short deltas, and my real short deltas were 350. And I sent the position to John Locke and said, hey, you know, this doesn't feel right. And he goes, well, you're short 350 deltas, but I see from the screenshot you gave me that you're only showing 209. So we went through and checked a bunch of stuff, and it was that damn volatility modeling thing down on the lower right-hand side in the matrix. And I checked it in the rut before I called him, and everything was perfect in the rut. You know, I wasn't having trouble with that position. And I'm having trouble, generally speaking, with the SPX. You know, I can't get anything to work in the SPX the last few months. So that's all it was. Inconclusive, honestly.
And how about, you know, because the thing is, I know that OptionView had done such a good job with their volatility models that in terms of where they were and what they were forecasting, had it changed more so for you? Because I know that the model that they end up using for the RUT is similar to that of the SPX, right? Whenever you have indexes, cash settled indexes where you don't get the dividend, but it kind of goes into the index itself, like in the RUT, the NDX. I know that you can't end up using just standard options models. You have, well, you can, of course, but you have to end up making allowances for that ends up happening. Had something changed in OptionView around the indexes?
I don't think so. I don't think so, because you have the choice of using lens model or a standard model or a Black-Scholes. You know, you have some choices there, and I don't fool with it much, honestly, but I should probably check it since some other things sort of randomly, independently changed. That's a good idea. I'll check it now.
Somebody ended up saying, take a look at Dollar Tree. You know, my God, what a rocket ride. Okay, this thing has been. You know, a couple of things when I take a look at the chart, everything was just, you know, off the charts, bullish on it, but how far does it end up getting extended? You know, one of the things is you take a look at any of the trend lines, okay, or maybe even this top right here. If I draw, let me just draw a couple of things on this. While I'm looking at this, Curtis, you know, while you're on, would you like to end up talking about anything else, or should I take a look at this one first and then we...
Yeah, do what you're doing there. I was looking at OptionView and checking to make sure all my modeling was correct.
Do that.
What were you going to look at? I didn't understand what it was you were going to look at. Somebody ended up asking if we would take a look at Dollar Tree. You know, one of the things... Yeah, go ahead.
Right,
yeah, go. I don't have anything to say. I'd just whine. You know, I would just sit here and whine.
You know, I always take a look at longer-term stuff. Obviously, you know, once we had broken out, you know, this W pattern, it's a perfect cup and handle, right, for you guys who are IB, okay, guys. I'm sorry, IBD guys, or Can Slim, okay, William O'Neill guys. Perfect cup and handle. I take a look at this thing. Once it broke out, it ended up really moving. Now, the one thing that I don't like, I never like to end up seeing, is gaps, right? And if you can see this area right in here, I don't know if I'm going to end up being, if I'm going to end up if you guys can end up seeing that. My Thinkorswim is just too slow right now. We have a gap over here, right? That happened back in November. Okay, and we've moved since. One of the things that I would end up taking a look at in terms of, well, how far can we end up moving up on this thing, and when is it time for us to end up going? The thing that I tend to end up using on this stuff is more Fibonacci retracements. So if I end up taking a look at a Fibonacci retracement, you know, maybe even from the bottom of the cup, or maybe from the breakout, from the handle, what I would end up doing is, you know, and you'll see this over here. Let me get rid of this studies. I don't know if you guys have ever drawn the stuff with a Thinkorswim, but if you go to Fibonacci extensions, the way you draw your Fibonacci extensions is that you go from basically low to high, back to low. Okay, and the challenge is when you've done that, okay, you've already blown through them. Now here's an interesting thing when you end up drawing that, and let me just come over here and show you this. You know, you take a look at this 100% Fibonacci. Once you broke through the top of that, right, because this is the extension, okay, you can see that we really have, you know, we're in uncharted territory here. I don't know with the right, because they had a buyout, right? Weren't they with Family Dollar was going to end up buying them, or I don't know the whole story with them. Does anybody? I'm taking a look at the chat. Anybody following? Okay, what's been going on with them from a business point of view? I know that they end up. So I take a look at this right now. I have no good answers. The only other thing that I can end up doing is I can end up starting to draw trend lines on this thing. So if I come over here and if I draw a couple of trend lines, right, you come over to here, and from here, maybe here. Okay, and then what I'll do is that a lot of times I draw a trend line backwards to see what point it's kind of cheating, right? Do you guys ever do this? I'll start my trend line here, and then I'll put it right there, right? Because that's a reasonable, you see what we had right here? And so you take a look at this, and now let me just come over here and make it a little bit bigger. Okay, so you got a reasonable channel. Okay, you're near the top end of a channel. You know, it's we'll have to end up trying to get somebody like Jerry first on. Jerry ends up having like all kinds of technical analysis. I tend to end up looking at, like I said, what I'll do is let me save these as my drawings. Okay, and we'll call this Dollar Tree. And I'll end up coming from here, and then I'll also take a look at, I don't know if you guys saw when I went through it before, but I'll take a look at my momentum indicators. With something like oscillators are useless in this, right? If you take a look at oscillators, things like MACD, stochastics, RSIs, Williams percent Rs, CCIs, they're all going to end up being, you know, just get all the way over to the right where we should be, right? Everything's going to end up being. One of the things that is troublesome, one of the things that I'll take a look at, if you've ever watched how far above the 200-day moving average you are, many times when that gets to be expanded to too far of a level, it does come back pretty hard. But, you know, with this, obviously, over the last, you know, four months or so, it's just continued to end up expanding. I mean, you take a look at this, it's gone from the mid-50s to, you know, 80, okay, during this time. So one of the things you want to take a look at, if you can't look at the oscillators, is the strength of the momentum, okay? So the momentum factors that I'll tend to end up looking at a lot of times is DMI and 80X or 80XR. The other thing I take a look at sometimes is, I don't know if you've ever taken a look at it, I guess this was John, what's his name? Who did the TTM squeeze? Oh, why am I drawing a blank? I'm sure one of you guys will end up knowing. Carter, thank you. John Carter's TTM squeeze. Okay, it was another very, very good momentum. If you end up taking a look, first of all, the level, and this is kind of, it's amazing, okay, here, that in the 80XR, that the strength of the momentum in this move higher has not been getting, you know, that much weaker. Let me get rid of these so you can end up seeing the studies here. Let me remove all the drawings. Couple of things, okay, when I end up showing you this. The first thing here is basically I'll end up taking a look at a regression channel. The regression channel that I end up taking a look at here is a regression channel 100. There's also a regression channel 50 that you can end up seeing. The regression channel, when you're at the very top end of the regression channel, you tend to end up coming off of it. I overlap the regression channels and also the Bollinger Bands. And again, if you take a look at the Bollinger Bands, the thing that we're starting to end up seeing here is that we're up near the top. Now, one of the things that ends up happening, okay, with Bollinger Bands often, and this is kind of the premise of the TTM squeeze, is that when the Bollinger Bands get tighter over here, you see how they expand it? You know what I'm going to do is I'm going to delete the linear regression so that it's easier to see. Let me make this smaller, and then let me expand here so you can see what ends up happening. One of the things that ends up happening is that many times when you have a move up or down, what will end up happening is that the Bollinger Bands will expand. When the Bollinger Bands start to get tighter, okay, that's when you tend to end up having another move. Okay, if you take a look at the Bollinger Bands got very tight, okay, in late December. Okay, it threatened the bottom side. It seemed to end up starting to go through, but yet it ran right back up on the other side. This happens many times with the Bollinger Bands where you'll end up moving from one side to the other. The interesting thing about this is that this line, which is the 50-day moving average, acted as just great support. So when you have 50 or 200-day moving averages like over here and acting as such incredible support, that tends to end up being very technically driven, maybe institutional buying. If you take a look at the selling here, is that you did have some selling on high volume, okay, but you then were matched with even higher volume to end up running it higher. One of the things that has happened here is that the volume has dropped off a lot. Okay, you are pushing things up, okay, in terms of on the up days it has had bigger volume, but the volume isn't nearly as high as we ended up having back in early January. The momentum indicators, as you can end up seeing over here, and let me pull these momentum indicators over here. Okay, so what you end up seeing is that, I don't know if you guys use a DMI, but let me end up showing you basically what it is. Basically, you have two factors, okay? It's a divergence indicator, and it basically ends up using the Wilder's, okay, divergence indicator, and it's basically taking a look at where the divergence is going either in a bullish or a bearish sense in terms of its momentum, right? It's very, very important. It's a momentum indicator. So what basically you're going to end up taking a look at in terms of the ADX is the white line that you can see over here is basically over the two DMI lines. And when it is going up, the momentum is getting stronger, not weaker. So for example, you know, you had strong momentum, okay, with the market moving higher here, and you can see that the momentum was getting stronger and stronger. Then during this period when you were flat, what happened is that the momentum was getting weaker. Not that it was turning around, it's just that it was flattening out. And what ended up happening is that after we flattened out, okay, over the last month, the momentum has gotten stronger again. And you can see this, okay, with the TTM squeeze, that it's trying to end up, okay, being a little bit quicker than the ADX. And you can see it's a pretty good indicator, and it's still strong. This is a freight train that I don't want to end up getting in front of. When it turns, might it turn hard? It might. Okay. By the way, if you want to take a look at this, because I look at this on the SPX all the time, you can end up seeing that our momentum indicators here, if you take a look at where we are, we've gotten a little bit stronger over this past, couple of weeks. But if I end up showing you, if you take a look at where my cursor is here, and if I select this, you can end up seeing that we're actually below, okay, where we had been for the better part of 4 months. So is the momentum slowing? I'm not going to say it's slowing, but it is lower than it has been, okay, for basically since that August sell-off that we ended up having. I'm sorry, that October sell-off that we ended up having. The ADX and the ADXR still, okay. Nothing's gotten negative. If you take a look at the TTM squeeze, right, it's still bullish. It's not growing, right? Light blue. Let me make this here. Let me look this up. Let's see, John Carter's, right? So you can see Carter's stuff is still bullish. Now it's on the back end of being bullish, okay, in terms of its momentum, but it's just it's a difficult market right now. It's a grind 'em up market. And when we end up having sell-offs, we're probably going to have, continue to see these, quick and sudden sell-offs. Will they be opportunities to buy? The answer is they have been. I think that they will continue to end up being opportunities to buy unless we get some type of rather serious systemic type of issue. Curtis. So what did you end up finding, or what else has been going on with your stuff?
Well, Jim, I just wanted to point out that you're writing an article for hedging for high volatility, and with the idea that maybe the market is, it's been having lower volume, maybe it's topping, and maybe we're in for kind of a big decline. So how would people hedge against that, a big move down? Do you have any thoughts while you're...
There's a couple of things. One of the, iVolatility asked us to write an article, and I have it about half done at this point, because you guys know that what I do with my partners over at EAB is that we end up building hedges. When we take a look at things, and I wish I would have recorded this for other folks. When we take a look at doing any type of hedging, a lot of times we'll take a look at it just on the SPY. Okay, when we take a look at this, what we'll end up doing is there's really only 3 possibilities that you can ever use. Right, there are 3 tools to end up hedging the downside, and some people might say there are only 3 tools to end up trading options. And those 3 tools are buying or selling, an individual option. Okay, buying a vertical, or buying a calendar, or buying a vertical. Some people would say that a diagonal is nothing but both of them together. One of the challenges that you end up having, and again, I'm on my Apple, and I don't have my LiveVol set up here, but one of the challenges that you end up having is just how incredibly expensive, okay, the put protection is right now. Like, for example, and I haven't looked at this in the last probably about 2 weeks since we ended up putting on our most recent downside hedge. But when I take a look at the implied volatility, okay, come over here. When we take a look at the implied volatility, let's move this thing down. And I have to get rid of a couple of columns here because I got too many on this screen. What are we going to get rid of? We want to keep implied. We don't need an extrinsic. We can end up doing the adding ourselves. And I won't take open interest. I don't need that. Okay. So when I take a look at the implied volatility going out, a month and a half, if you take a look at the money at 12.5 versus, say, going down, 12 points, okay, why 12 points? I was just picking something that was going to end up being, a little bit more than 5% down. Look at the implied volatility here. Okay, it's 17. It's 12.5 versus 17. your implied volatility is 50% higher. Okay, if you go down and take a look at doing something, and by the way, that was just 15 delta, right? I know some people like to sell, anywhere from 10 to 20 deltas. That's a very, very big difference. I'll tell you, a 50% difference in the IV is kind of substantial. We at EAB, what they end up doing is that they measure, okay, how steep that difference is. They call it put skew, by the way, right? Because it's the skew or the difference between the at-the-money implied volatility versus the puts below the money. That put skew, when we ended up having to re-hedge about 2.5, 3 weeks ago, it was at a 3 standard deviation. Okay, think about that. What that's saying is that people aren't afraid, right? Institutions aren't afraid of having small pullbacks. They don't even worry about that. They're worried about substantial pullbacks. And so what ends up happening is that the implied volatility ends up getting to be much steeper. Put skew gets to be much steeper because there's the fear. If it does happen, the fear is that that'll end up having bigger moves. This is why when we've had drops, okay, the VIX has moved as much as it has. The other thing that we ended up seeing is that the term structure just means what the short-term implied volatilities are, or how expensive the short-term options are versus the longer-term options, is also pretty steep. If you take a look, again, those average, okay, Aprils are trading at 14.6. If we end up going out, towards the end of the year, okay, in December, we're at, almost 19. So again, fear is not that it's going to happen quickly. The fear that it's going to end up happening over time. A couple of points that I want to end up making. March during my lifetime has been a pivotal month. Think about when did we hit the bottom after the sell-off in 2008? We hit the bottom in March of 2009. After one of the biggest run-ups, okay, during my lifetime, during the dot-com boom, when did we end up, okay, hitting the top and turning? March. For you guys who end up reading the Trader's Almanac, March is kind of a pivotal month here. So, I kind of take a look at this. We have Curtis back in a month, and he might not be whining. He might be celebrating.
I hope you're right, buddy. I'm short a lot of delta right now.
So and here's the thing about being short the delta. If you're short delta in a John Locke type of fashion, all you got to do is bide your time, right? Because when that pullback, right? It's I don't mind. It's in some ways John Locke is almost the opposite of picking up pennies in front of a steamroller. Right? Yeah, I lost a few dollars, but I made a boatload when this ended up happening. The key is just to end up having the discipline. And Curtis, probably one of the worst things that you can end up doing is keep changing your opinion. The thing that I love about, the way John ends up approaching things is that it's the same discipline all the time. This is what we're going to play for. Here's where we're going to end up making you money. You don't want to have to wait, and then all of a sudden you get the big pullback and you gave up last month. So you don't have the trade on.
Yeah, and also because his trades don't get down a lot of money on short-term moves, you don't make panicky sort of whipsaw type of trades so that you're covering your tails. You really don't have to do that. It's much more comfortable for sure.
That's absolutely key, because, one of the things that ends up happening, and I'll show you a trade that somebody wanted to end up putting on the other day, and I just thought, I was like, oh my God, I'll take the other side of this trade. What they wanted to end up putting on was, how to end up protecting the downside. So the challenge was, if you sell a covered call, the problem is that selling covered calls over the last 3 years has been a losing proposition. And the problem is that the implied volatility, okay, remember I showed you the puts, but the implied volatility above the money, you know, I skipped over that part. Look at how, if we go a little bit above the money, look at how low the implied volatility is, you know, if I go a few points above the money. It's 8. It's 8. Okay, you know, how do you make any money selling an 8 volatility? So the challenge is that there's not a lot of you know, money to be made in selling covered calls on it. So it's a pretty big challenge, I think. And here's where you'll get absolutely killed, by the way, is that some people end up liking to do these collars. If I do this, now the market's moved up, so let's do this as an equidistance collar. Let's go maybe say 5 points above and 5 points below. So that would be 17, right? And then 5 points below, and I'll even give you the extra 6 cents, right? Okay, and then 5 points below would be, let's go up here. Okay. Look at how horrible that is, right? Look, what I have here is a collar, okay? And if you take a look, the center collar is, I'm going to call it 212, right? I've given you 7 cents. So the 7 cents, you know, is a gift, okay? But if I go 5 points above, okay, I'm at 217. If I go 5 points below, I'm at 207, okay? And even with that, if you take right here, you can watch the red number. I make $350. I lose $650. That is why skew kills you. That's why you can't end up buying puts or just try to use collars to end up hedging today. It's just it's an asymmetrical risk. You would be almost better off, okay, you know, shorting the stock and doing this in the opposite direction. You know, if I showed you doing it in the opposite direction, okay, you would be better off doing something like that, okay, where you would sell the put, buy the call above the money, okay, and to me, this is a lot, you know, it's a lot. Now, granted, okay, please, 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 you do not evaluate these trades by the amount of margin you end up having, right? Because what ends up happening is that people end up saying, oh, look, the margin isn't very much because I only had to put 20% of my put down. Yeah, but if it goes down, you have the risk of 100% of it, right? The put is you basically, once you get below 207, it's as if you own the stock, okay? You're going to lose dollar for dollar. So don't end up thinking that if you only end up putting up 20 cents on the dollar, you know, you don't have the risk. Yes, you do have the risk. But when you take a look at this overall, if I wanted to end up being on the upside, and if, you know, the problem is that I just don't, you know, there's a reason why the skew is this steep. It's not like, you know, the institutions are just making this stuff up. It's that there's real fear that if there is a pullback, it can end up being substantial. Now, having said that, if you take a look at the probabilities, that's a pretty decent probability trade of, you know, selling your put below the money if you want to get long and buying a call. You can end up taking a look at where the skews are, where the implied volatilities are. The thing that I like about a trade like this, and not this specific trade, but this in general, when we come and we take a look at the 207 and the 217, we're selling a 14 vol, and we're buying an 8.8 or a 9 vol. Okay, I like trades where I'm selling vol that's not twice, but, you know, it's approaching twice as expensive. Okay, Tom, I see a bunch of questions coming in here, and I know I've missed other things. Let's go to the recent ones.
Steven said better to use a put fly for protection, cheaper. And then David Stewart, put fly can work very well, just needed to wait for it to mature, and you end up, if you end up needing it, And then Stephen agreed, Dave, using shorter duration allows it to happen. Then David says, not better, just another way.
Yeah, see, the problem with the put fly is that the flash crash was how many years ago? Was it 4 years ago?
That sounds about right. 5, okay.
5 years ago, thank you. I remember where I was. Curtis, do you remember?
You know what? Yes, I do. I was on the golf course and I didn't know anything about it, and it was over before I panicked. I came back and I said, "What is that?" I thought it was a misprint. And I looked at it.
Do you remember the day after the flash crash?
I do, yeah, I do.
Okay, because on the day of the flash crash, I ended up taking care of some stuff, and I had on a put butterfly below the money. By the way, the day after, I was driving up to Curtis's house because we went to see the players. Okay,
right.
Got golf tournament. So anyway, but before I got in the car to drive up, to Curtis's house, I had on a put butterfly below the money, well below the money, in the ruts. And what ended up happening was that when the market dropped, the implied volatility went up so much that my put butterfly didn't make very much at all. There's a concept of convexity that every institutional manager talks about. And other than with Dave Stewart, I've never talked about convexity with any retail trader, practically ever. Yes, Stephen, it's always a trade-off. Let me show you, the difference here. And a lot of people I know like the rut, so I can do this in the rut of the SPX. Let me show you again, let's use April. And if I do something like now remember, John Locke's trades are a little bit different. He's not using them to hedge, right? He's using them as income. So I realize that John does this a little bit different. But right now we're trading at 1242. So let's go, say, 50 points below the money. Okay. And what I'm going to do is I'm going to end up buying a deep and wide butterfly. Okay. So here's my butterfly, much cheaper, than buying puts. The challenge, and I know that some of this is going to end up being a little bit off with their Greeks, but I want you to see what happens if I end up jumping my vol. Right? Do you guys know about this? Okay. What I'm looking at here. Let me go back and I'll show it. Let me explain before I jump, right? This is a typical, pattern that you guys have seen, 100 times before, You're taking a look at your risk reward as you go down. Everybody thinks about the white line. Okay, the white line is what ends up happening. The white line is your P&L, but it makes two major assumptions. Okay, it makes the first assumption is that nothing happens to volatility. Okay, that's the first thing. Nothing happens to volatility. And I know that a lot of you guys who look at this or use an option view or OptionNet Explorer is that we take a look at this and we can take a look at the vol steps. And what this ends up showing you is this shows you what vol would happen is if it goes up, by 5 points. You see, I have a 5 up here. So it shows you, currently it's at 16. What happens if it goes to 21, to 26, 31, to look at what happens if volatility spikes high enough. If we go down, my below the money, negative delta butterfly can actually lose money. This is what happened to me, the day before I drove to Curtis's house during the flash crash. So it doesn't end up helping, when you actually need it, Whereas if I did something such as, and what we'll do is kind of just end up showing you this. If I end up doing, and I'm going to do the, not the John Locke version, but what I'll do is that I'll end up buying I'll buy something very deep in the money, just to kind of end up simulating that we bought 900. Okay. So basically, this is just buying the stock. By doing something like maybe buying puts, and I'm not advocating buying puts, I'm just saying, okay, if I end up doing something like buying puts in some type of, let's say, a calendar fashion. Okay, so what I would end up doing is, let's do, I'll sell the, here, let me just do this way. Give me a second. And we'll do this on 1150. Get rid of this. 1150, and we buy two of these. Okay, what I'm doing here is that I just bought something real deep in the money to simulate stock, right? Because I would do this in IWM. But if I do something like this, where I'm buying stock and I've done a calendar spread at, right, if you take a look, here's my calendar spread. Right, here's my calendar spread below the money. Right, I've bought one, right, and I've sold one. Right, I bought the May, I bought the May, sold the April. If I own the stock and I buy the extra put in the back month, so I'm going to end up buying the 900 calls to simulate buying stock, and then I'm going to end up doubling, okay, my put that I bought. What you can see ends up happening here is that I end up taking a lot of this sting away if we come down to a certain point. Plus, since I'm long one puts, even if the market goes to zero, now remember, I bought the 900, that's why it goes up here. If I had the stock, it would be flat, okay? You can end up seeing that I don't have much of an issue. But here's the difference when it comes to convexity. Let me do that same thing with what happens if vol ends up jumping. Take a look now, as you go further down, my lines don't get pushed down, they get actually pushed up, right? You see the implied volatility? So when you take a look at this, you can't end up just saying, you know, people sometimes look at, oh, well, I'll buy the butterfly and it'll end up helping to protect me. You know what? Yes, if it lands on the center of your butterfly, okay, at expiration, you'll make a lot of money. But when it gets that volatile, you know, Curtis, you've heard me say this, I kind of say only partially joking, you know, when you end up having that volatile of an environment and you plan on holding the butterfly all the way to expiration, if you think you're going to stick that landing and land on the top point of the butterfly, you got a better chance of getting hit by lightning after you've won the lottery and you're walking in cashing your winning lottery ticket. It doesn't happen very often. It really doesn't. So what we'll end up doing, or what I'm going to be writing the article on, is how to end up hedging and how to end up, I'm not going to use the word convexity, I do to you guys because you guys will understand it. All convexity means is that the worse something gets, I need my hedge to help me more, not less when I really need it. That's the bottom line on it. And I missed a whole bunch of stuff from Himanshu and other folks. Himanshu, I didn't realize that you were on, otherwise I would have asked you to come on. We are getting close to our time.
Yeah, I asked them if you wanted to be a panelist, but we were running out of time, so he said next time. So yeah, we'll cash in that chip next week.
Okay, good. If we just kind of go back and take a look, I'll start from the bottom going up, Tom, if you take a look at it. Yeah, Dave and I have had this conversation about maybe, Dave, if you come on either next time or the time after, because I'd like you to end up taking a look, and I know that you have certain thoughts in and around this whole concept of convexity that's important. If I go back, let's see, agree, IV doesn't rise, okay. Steve brings up a very, very good point that it doesn't raise linearly, okay? What ends up happening, okay, remember I told you, I only gave you one. There were two things when vol ends up jumping, okay? The first one is that the short-term vol, okay, to Stephen's point, ends up going up much, much faster than the back month vol. So doing this graph that I just showed you, it's kind of cheating, right? It's not going to give me a real accurate one. What I'd have to end up doing to be proper is that I'd have to say, well, the front month vol it's going to end up, say, going up 20 points, but the back month vol might only go up, the second month vol might only end up going up, 12 points, 10 points. So they won't go up evenly. That's number one. Stephen, the other point that I don't know if you were also referring to, but also the implied volatility doesn't go up evenly even in the same month. Meaning that, remember that huge difference that we saw between the first and the second month here? We saw the big difference, between the implied volatility, of at the money, and I know I'm on the red, so it's going to be a little bit different. But if I end up showing you the 1240, which is at 16.5, and we go down 100 points, it's at 21.1. The steepness of that difference, or the skew between those two, when the market drops and implied volatility goes up, that skew tends to flatten out, which means that the implied volatility that's at the money is going to end up being much, much higher as compared relative to the next 100 points below that. So what ends up happening is that when you buy these puts, okay, way below the money, don't expect their implied volatility to go up nearly as much as the overall curve will. Okay, so it's almost like this double whammy, okay, in terms of you have to understand how skew is going to change, and you're also going to have to understand how the front month implied volatility is going to go up a lot more than the back month volatilities. I will end up doing one last point on this. I'll end up showing you guys, and let me come over to here and take a look at VIX Central. Let's get rid of this. Okay, here is a implied volatility curve that's pretty much in contango. I know it's the VIX futures, but it's not that different than the implied volatility on the SPX in each of the months. And you can end up seeing that on the left side of the chart. Okay, on the left side of the chart, the implied volatility is lower than in the back months. So the difference of how steep this is pretty high at this point. If I end up going the way they had set this up, nice enough of them, is that if you hit historical, they take you to one of the worst days in history, okay, in terms of how steep the skew was. Mid-October 2008. Take a look at what happened here. In the back month, we go from 18 up to almost 28, right? So it goes up 10 points. Look at what happens in the front month. You go from 15 to 63, okay? You go up almost 40 points. So the front month, the front part of the implied volatility in terms of this whole term structure, right? Because we're talking about different time frames. The front month goes up much, much more than the back. So if you think that you can end up buying a put, okay, as a leap, the challenge is that you're going to have to make all of your money on delta, okay, not on volatility. So that's why, doing those calendar spreads and maybe, buying your extra puts in the back month are going to end up being better ways to end up protecting. But the problem is that depending on where they are, you also have to worry about the skew, okay? And what we'll end up doing is that I'm going to do two things. One, I'm going to end up writing, I'll write the article. I'll also end up comparing, okay, some of the more, I guess, classic SIBO methods of hedging. For those of you that have never seen it, but there was a SIBO paper, I'll refer to it, and I'll end up writing on this so that you guys can see this, on how to end up hedging. And they just talk about mostly covered calls, at the money, above the money. They also do some collar stuff. You'll see the difference. And the challenge is that if you don't at least trade around that convexity point, you go back to this same hedge, right, where we had it on the SPY. And if I come back over to here and the rate, if you do the normal hedge, where you're selling a covered call and just buying the put, you have horrific, absolutely horrific risk reward. You know, if the market goes up or down, if it's a coin flip, and it usually does go up more than it goes down, so it's not even a fair coin, it's more of a bullish coin, so it's going to end up happening slightly more, but you can't be risking, okay, 600 right over here. So you can't be risking $644 to make $356. That's a losing proposition. So anyway, Curtis, any last things that you want to end up mentioning, or that you've been trading, or you've been working on?
Yeah, just so that it is said out loud. Remember not to believe theoretical modeling going forward.
Yes.
You know, there's a real disconnect, and it's become a part of most of the conversations that I've heard from you in the last couple of months, Jim. We're really sort of focusing in on the fact that this is theoretical pricing, and everything changes. You know, those puts below the money in the SPY are high volatility, not because there's something about the volatility, but because they're expensive. You know.
Yes.
The volatility is derived from the price. Remember that. Implied, you know, we never think that word means something other than implied, but you know, it's just implied by the price. So the fact that, you know, 50 points above is 8 IV and 50 points below is 16, 17 IV means that a lot of people are shorting this market right now, you know.
Right.
And the guys, when you hear people on CNBC talking about what they think is going to happen next, all these guys are getting squeezed, you know, on their shorts. So, you know, they're huddling up. They're getting shoulder to shoulder with the idea that prices need to come down. And then somebody else is taking advantage of the fact that they keep going up and they're selling those expensive puts. You know, everybody's got an angle. But, you know, the basic truth is that if the price of those puts goes up, the implied volatility goes up. Not if the implied volatility goes up, the price goes up.
I mean, does everybody understand what Curtis said? Because, I mean, that is so insightful that you have to understand that. Okay? Because the word implied, because everybody, well, you know, I've gotten asked sometimes, I get asked questions, and sometimes, Curtis, I know we just assume that people know things, but the word implied volatility, what happened was that's when, you know, the Black-Scholes model was first written, and Dr. Scholes and Dr. Black came down to the floor of the CBOE, and they told them what they ended up doing. You know, there were all of the components, right? The strike price, the day's duration, okay, the stock price, the dividend, everything, the risk-free rate, everything was known except for one thing. What's the volatility that you put in the formula to get the price? Okay, what we end up doing today, and it's just kind of assumed because of the way it is, now we basically, what Thinkorswim does, when they give you the implied volatility of, you know, like one of the strikes that we were talking about the 211, and we said the implied volatility is, you know, 12.5 right there. What they're doing is that they're taking the bid and ask price, they're taking the mid, they're putting the price into the Black-Scholes model, whichever model you happen to end up choosing down here. Okay, and then they reverse engineer it to saying this is the volatility that we would have to end up putting into the model to get that price. So basically what implied volatility means is that today's current market price is implying a volatility of X, and in this case 12.5%, and at every strike. So that implied volatility is really telling you a lot of things. You know, I'll leave you with this last quote when it comes to implied volatility and understanding exactly what Curtis just ended up mentioning. I one time heard somebody say, I'm not a big TV guy, but I know some people really like the show CSI. And right, if you guys know, right, it's crime scene investigation, and they go through and they do a lot of DNA testing and other stuff like that, said if Wall Street was CSI, options would be DNA. Learning how to end up understanding, reading those tea leaves, and how they'll actually move when the markets end up changing. Probably the most valuable thing that I could end up seeing anybody using OptionView and some of the things for is go back and take a look at the relationships of the implied volatilities of at the money, below the money, and going out in time, and see how they moved during different times. It's really, really amazing. Curtis, thank you so much for coming on, and thank you for bringing out that really, really important point for everybody. I greatly appreciate it, and I know our listeners do too.
Sure. It's good to see everybody.
You
Thanks,
take care,
Curtis.
though.
Take care.